Roger, we go over to Jonas for a question from Ava for you. I'm 35 and looking to buy my first house. I make $63,000 per year. I fell in love with a house that is $175,000. Running the numbers, the mortgage payment would be around $1,350, including property taxes and insurance. It's about 25% of my gross income, which I know is in the recommended range. But after contributions to my 401k and HSA, which I don't want to change, the expense of the house makes up about 50% of my net income, which seems scary. Does this sound like I would be taking on more house than I can handle? There's a big question about this, especially now when we have these really inflated housing prices at this point, Jonas.
Great question, Ava. You're smart to look at your gross and your net income when it comes to trying to factor in that mortgage payment. You're going to have lenders look at your gross income, but we talked a lot on the show that ultimately you're going to have some monthly flexibility in your financial budget if you acquire this house, because if you look at just a few things, maintenance, utilities, and repairs, you're going to have 1 to 3%, Doug, of the actual value of the home. So $175,000, upwards of, call it $5,000 in maintenance, utilities, and repairs of this home. And that doesn't include any type of remodeling. The remodeling costs in the Midwest, $10,000 to $13,000. Again, if we were on the East and West Coast, they would love to have that remodeling number with their homes. But ultimately, great job. You need to really focus on having some monthly flexibility, and I would go back to that savings account, some type of an emergency account. I think, Roger, you mentioned at some point you would like people to have some type of a house fund if they get into a new house, and then that way they're not surprised. If they can swing the payment right away, they would have some type of a slush fund in case they had some type of an emergency, a maintenance situation, and they can go ahead and repair that without being kicked out of the house.
If you're buying a pre-existing house and your payment's $1,500, it's really going to be $3,000. That's what I tell people. That's what you're really going to spend is $3,000.
Yeah.
Because water heater's going to break, roof's going to have a leak. There's going to be something. You know, I've been fortunate that we've lived in fairly new homes, all built within like a year or two of when we purchased them. Part of the reason I do that is so I can afford, or I can avoid, the upcoming maintenance. I did have a house built in 1984, and guess what? You're fixing something every month. There's always something wrong. Every month.
Come on.
And let's think about first-time home buyers. That's what they're buying. They're typically buying homes that are 20, 30, 40 years old. So they don't even know the repairs. In fact, we have a good friend whose son just bought his first place. And this is exactly what happened. They bought it. Well, then they needed a fence. Oh, that's $5,000. Thought they were going to do it themselves. Well, guess what? There's still no fence. Wanted to paint the house. Well, that was 3 times what they thought it was going to cost. So just all of the stuff adds up that people don't think about. They get all wrapped up into what the payment's going to be. They forget about all the auxiliary stuff.
And ultimately, Ava, we'd like to see you continue your savings rate. You're doing a great job saving in your 401k, your HSA. We're not saying don't buy the house, but just have a backup plan of flexibility after you get into the your starter house. But congratulations. It is the American dream, and you're being very smart about it.
It's interesting because I'm hearing more and more people in the podcast sphere talk about, is it really the American dream? Is it something, I mean, do you really have to have that house? At what point in, where do we make that transition at something like this? She's 35. Maybe the first thing is come in. Let's get a financial plan put together to see what everything looks like, because you can do projections. You've got the software to sort of spreadsheet that sort of stuff out, right?
And I would say have some mentors too. Like Roger mentioned, his friend that knows everything about houses. Elias, you know a lot about houses too. Ava, grab a mentor and have this person that's not trying to sell you anything walk you through the structure and maybe determine what your short-term expenses are going to be right away. And this person might be able to help you out, and you might be able to get into this place and just expect to pay for some of these repairs that you didn't expect before.
Again, common sense answers. This is something where it's your financial future, but they understand that they are with you as part of your team. You can count on them for the education and the inspiration as well as whoa, maybe you need to hold back a little bit, or, okay, let's move forward. It's ultimately up to you, but when you've got folks like my friends at Premier Investments and Wealth Management on your team, you know you're going to be able to count on them for reasonable advice all the way through, from the time you're mid-30s like you, Ava, with what you're doing, all the way to the folks who are going to retire early and fire at 55 if you want to, and beyond. And beyond, because there's a lot more that goes along with this. And Premier Investments and Wealth Management will have that. They've got a lot of downloadable information at premieriwm.com. You can head over there, or you can call for your appointment at 800-383-6590. Premier Investments and Wealth Management, named a Forbes 2025 Best in State Wealth Management Team.
Securities and advisory services offered through LPL Financial, a registered investment advisor, member FINRA SIPC. The opinions voiced in this show are for general information purposes only and are not intended to provide specific advice or recommendations for any individual. To determine which investments may be appropriate for you, consult with your attorney, accountant, and financial or tax advisor prior to investing. Premier Investments in Wealth Management and LPL Financial do not provide specific individualized tax or legal advice. We suggest that you discuss your specific situation with a qualified tax or legal advisor. Rebalancing a portfolio may cause investors to incur tax liabilities and or transaction costs, and does not assure a profit or protect against loss. Economic forecasts set forth may not develop as predicted, and there can be no guarantee that strategies promoted will be successful. All performance referenced is historical and is not a guarantee of future results. All indices are unmanaged and cannot be invested into directly. There is no assurance that the techniques and strategies discussed are suitable for all investors or will yield positive outcomes. The purchase of certain securities may be required to affect some of the strategies. Investing involves risks, including possible loss of principal. There is no guarantee that a diversified portfolio will enhance overall returns or outperform a non-diversified portfolio. Diversification does not protect against market risk. Contributions to a traditional IRA may be tax deductible in the contribution year, with current income tax due at withdrawal. Withdrawals prior to age 59.5 may result in a 10% IRS penalty tax in addition to current income tax. A Roth IRA offers tax deferral on any earnings in the account. Qualified withdrawals of earnings from the account are tax-free. Withdrawals of earnings prior to age 59.5 or prior to the account being open for 5 years, whichever is later, may result in a 10% IRS penalty tax. Limitations and restrictions may apply. Traditional IRA account owners have considerations to make before performing a Roth IRA conversion. These primarily include income tax consequences on the converted amount in the year of conversion, withdrawal limitations from a Roth IRA, and income limitations for future contributions to a Roth IRA. In addition, if you are required to take a required minimum distribution, RMD, in the year you convert, you must do so before converting to a Roth IRA. Forbes' Best in State Wealth Management Team's ranking was developed by Shook Research and is based on in-person, virtual, and telephone due diligence meetings, and a ranking algorithm that includes a measure of each team's best practices, client retention, industry experience, review of compliance records, firm nominations, and quantitative criteria, including assets under management and revenue generated for their firm. Investment performance is not a criterion, because client objectives and risk tolerances vary, and advisors rarely have audited performance reports. Shook's research and rankings provide opinions intended to help investors choose the right financial advisor and team, and are not indicative of future performance or representative of any one client's experience. Past performance is not an indication of future results. Neither Forbes nor Shook Research receive compensation in exchange for placement on the ranking. For more information, please see www.shookresearch.com. Shook is a registered trademark of Shook Research, LLC.